Okay, class, we're about to get started on section 3.5, which is on page 267. We're going to cover 3.5 and 3.6 today, and it should be a shorter lesson than it was for 3.3 and 3.4. So with that being said, lesson 3.5 is a walk on Wall Street, and our learning objectives is to read information from a stock listing, to calculate costs of buying stock and profit or loss from selling. Study the price to earnings ratio and use it to analyze the value of a stock. Calculate profit from a bond sale. All right, at the bottom here. Well, wait a minute, let me straighten this out. Okay. At the bottom here, it says basic definitions. As a shareholder in a company, you own part of that company. When the company makes money, it could choose to distribute part of the profit to its shareholders. This money is called a dividend. The stockholder receives a sum of money based on the number of shares of the stock that he or she owns. Sometimes, if a company doesn't make a profit or its owners or managers decide to reinvest the money into the company, no dividends are paid. So, when choosing whether to buy stock in a certain company, one consideration is whether or not that company typically pays a dividend. It says if you own a stock in a certain company, why are you entitled to a periodic dividend? And the reason is you are part owner. That's why you are entitled, because you are a part owner. Okay, now we go here to the back. Okay, now it says number 2. Describe any advantages or disadvantages of buying stock in a company that pays dividends. Okay, like I've done before, I'm just going to do one pro, one con. One pro about owning stock in a company, you could receive dividends. The con, you can lose money if the company is not doing well. Okay, now we go down a little further here. It says, besides issuing stock, a company can also issue bonds. Usually, bonds are issued to raise money for the company for startup costs or special projects. A person who purchases a bond is really lending money to the company. The company, in turn, repays the owner of the bond its original value plus interest. As a general rule, bonds are a safer investment than stocks, but stocks have greater growth potential. Describe the difference between stocks and bonds. Stocks are part ownership in the company. Bonds are a loan to the company with no ownership. Now, there are a lot of other differences, but these are the main ones here. When you buy stock, you're a part owner. When you buy a bond, you're just basically lending money to the company with no ownership. Now it says stocks can be bought and sold on a stock exchange. The price of a stock, which varies from day to day, even from minute to minute, depends completely on the amount that investors are willing to pay for it. This can be affected by the profitability of the company, the economy, scandals, even global political concerns. Investors buy or sell stock through a stockbroker. Traditionally, this was an individual working for a brokerage firm, but it has become common for people to use online brokers, in which the investor initiates the buying and selling of stocks online. In either case, the brokerage charges a fee called a commission for the service of having their representatives buy or sell the stock at an exchange. Bonds can also be bought and sold like stock. So number 4, how can an individual buy stock in a company? You could do it online. What is that? Online broker or a live stockbroker. And for the sake of this class, I'll just leave it there because there's other ways you could buy stock as well. But we'll just leave it with the online and a live stockbroker. Okay, number 5. What are some advantages of investing in the stock market? Well, one advantage is potential for profits and ownership in a company. Those are a couple. All right, now we move on to the next page. Now it says investing in stocks. When all is said and done, there are 2 ways to earn money from stocks: buying a stock that pays a regular dividend and selling shares for more than you paid for them. This means that investors are tremendously interested in the day-to-day price fluctuations of stocks, as well as indicators of how well the company is doing. A stock table is a listing of key information. Stock tables can be found in newspapers and online financial sites. The stock table shown below, generated at 10:37 a.m. on September 4th, 2015, is for a company called Computer Programming and Systems, Incorporated. Let's see if we can make sense of the mysterious mass of numbers. Now, before we go through these numbers, right below here in these paragraphs, it tells you what these different values, what these different terms mean. So for instance, ticker symbol. Ticker symbol is what is recognized. It's usually an abbreviated name for the company, but sometimes the letters have nothing to do with the company. So just to let you know, this is an identifier from the company aside from the company's name. Like, I know a lot of you know about Coca-Cola, right? Everybody has seen at least a Coca-Cola, correct? I'm going to take the silence as yes. Okay. Now, its ticker symbol is KO for Coca-Cola. Now, I really wouldn't think of it being KO since it's Coca-Cola, but that's its ticker symbol. So if you wanted to look up the stock, you could either type in Coca-Cola or you could type in its ticker symbol, which is KO. Okay, now, previous close. The previous close just basically tell you what it closed the day before. What was the last price it traded at the day before. So right here, when it says previous close, that means yesterday it was at $45.44, which was the last trade. And if you notice here, the new price minus the previous close gave us this 5 cents in profit. Now we have the next thing, which is open. Now, open means what was the price of the stock as soon as the stock exchange started. So it opened up a little lower at $45.02. Okay, now we have another thing here, which is the bid and ask. The bid is basically people that want to buy into the stock. They're making a bid as far as how much they want to pay and how many shares they want to do. The ask is typically by the owners of the stock who would put out a price that they want. And typically the bid and ask are different because whenever they become the same and then there's enough shares, the order is fulfilled. So now, we also had a 1-year target estimate is what analysts are predicting the price is going to be a year from now. Okay, the next thing you have is this word called beta, refers to the volatility of the stock, and then it just basically tells you how much the price fluctuates. Now, one key thing about the beta, if the beta is close to 1, then the stock stability is similar to the rest of the market. Lower numbers indicate that the price is more stable than average. Then you have earning date, basically reflects the next time the company is expected to release data on how well the company is doing financially. And then the ranges, you have a day's range and the 52-week range. So with the ranges, they give you the lowest price to the highest price. For the day's range, it would just tell you the lowest price for the day up until the highest price for the day. And then for the 52-week, they'll go one from the day that you're looking at the stock. It will go 1 year back, and then it would calculate the lowest price that there was during that 52-week period and also the highest price. Now, the average volume, now, I have to scoop this up. Average volume, it says 3M, that means a 3-month average. And then what happens is this here. If you have a low number, that stock is usually hard to buy and sell. But if it's a higher number, then you will be easily able to buy and sell that stock if you hit the right prices. Okay, now we move on to the next page. It says market cap is the total value of the company. It's calculated by multiplying the number of shares that have been issued by the current market price. And then we have price to earnings ratio. This is particularly important number, so we'll study that in the detail a bit later. EPS, that's earnings per share, represents earnings per share or the amount of money the company made for each share of stock that has been issued. Clearly, bigger is better here. Dividend and yield is the dividend that the company pays for each share and what percentage of the current price that represents. If nothing else, this tells you whether or not the company pays a dividend on shares, but you can also use it for comparison purposes with other stocks. Now, we're going to look here at Facebook. Now, this was done on September 4th, 2015. This is what Facebook was looking like. So we go down here to number 6. It says, what is the current price of the stock? The current price is usually in this big bold print here. So the current price would be $87.27. And then they ask, what are shareholders trying to sell it currently asking for? So you would go to ask, and then they're asking for $87.07. All right, now, what do analysts predict the price will be in 1 year? So we'll go to the 1 year estimate, which will be $111.75. Now, number 8, is this stock more or less volatile than the market as a whole? So we'll go to the beta, and the beta is less than 1, so it's less volatile because beta is less than 1. Now it says, what is the highest stock price in the last 52 weeks? Okay, so you go to the 52-week range. The highest price was $99.24. Now number 10, it says, does Facebook pay a dividend to shareholders? They have N/A, so the answer is no. So they don't pay a dividend. Okay, now we move on to the next page. It says use the market cap to find how many shares the company issued. Okay, so the market cap for Facebook, which shows it right here, is 245.89 billion. Now, to find out how many shares it is, remember the market cap is basically the current price times how many shares it is. So what you could do is, since this is how much the market cap is, all we have to do is divide it by the current price, and we'll have how many shares have been issued. So let's rewrite this, 245. Let's write this out in billions. So this is 245.89 billion written out. Now we're going to divide it by the current stock price, which is $87.27. So we'll put this in a calculator. Let me grab my keyboard. So we had 245,890,000,000 divided by $87.27. All right. So now this is a good example here for your calculator. If you notice here, let's make sure we wrote this. Yeah, we wrote this correctly. We divided by 8727, but it has this long decimal times 10 to the 9th power. All this means is we move that decimal 9 places to the right, and that will be our answer. So we will move it 9 places to the right. So 817 is 3, 577 would be 6, and then 632. And then 0.6. Now we know we cannot have 0.6 of a share, so it'll be approximately 281,757,7633. And let's see what this is. So this would be about 2,817,577,633 shares. That's how many shares that are out for Facebook at that time. All right, as previously mentioned, there are 2 ways to make money from stocks. Buy shares of the stock that pays dividends, or buy stock at a low price and sell it at a higher price. But of course, you can't just go buy stock at the corner store. You need to use a brokerage firm, place it in an order, which is then carried out by representatives at the stock exchange. In exchange for that service, the broker charges a commission, which varies among brokers. Brokers can also make recommendations concerning what stocks to buy and sell, which further justifies their commissions. The amount that an investor receives from the sale of a stock is called the proceeds. The proceeds are equal to the amount of the sale minus the broker's commission. Next, we'll look at some examples of buying and selling stock. Shares of Apple Computer, AAPL, closed at $12.89 on April 1st, 2004. Suppose that an investor bought 600 shares at that price using a broker that charged a 2% commission. So they say find the amount of commission that was paid. So what we're supposed to do here is take this 600 shares and multiply by the $12.89. So that would give us $7,734. Now this is how much we paid for the stock, but we just want to know how much the commission is in this problem. So we would take this $7,734 and multiply by the 2%, which is 0.02. So we could do multiply by 0.02. And that would be $154.68. That's how much the commission was. Now it says find the total cost of buying the stock. So you would take the amount that the stock costs plus the commission. So it'd be $7,888.68. Okay, now we come to 14. A stock split occurs when a company increases the number of outstanding shares. Most commonly, this is a 2-for-1 split in which the number of shares doubles. This can be done for a variety of reasons, but the simplest explanation is that when the price of one share gets particularly high, it tends to scare away smaller investors, and the split effectively halves the price of one share. In any case, the net result is that in an instant, the number of shares owned by shareholders doubles. Apple did a 2-for-1 split on February 8, 2005, then a 7-for-1 split on June 9, 2014. How many shares would our investor have owned after the second split? So first of all, we did 600 shares. So we would do the first split. The first split is a 2-for-1, so the shares doubled first. So that's 1,200 shares. Now there's 7-for-1. So 7-for-1 means that the shares went up 7 times. So we would take this and multiply by 7, and that would give us 8,400 shares. Now we go to the back. Now for 15, says our clever friend, the Apple investor, could have sold her shares for $130.28 on June 1st, 2015. If she had done so using a brokerage with a 1.5% commission, what would her profit have been? Remember, profit is the difference between cost and final proceeds from the sale, which would be selling price minus the commission. Okay, now watch this. First of all, let's find out how much it was when she sold it. So we take 8,400 shares that she had and multiply by $130.28. So 8,400 times $130.28. Okay, so that would give her $1,094,352. Okay, now that's how much was made on, well, that's how much you got paid from the sale. Now we have to deal with these different commissions. So we would take this $1,094,352 and multiply by 0.015 to get that 1.5% commission. So that would be $16,415.28. Okay, that's the commission. Now, in addition to the commission, we have to go back to our original amount that we paid for this stock. We paid $7,888.68, which included the price of the stock and the commission. So now we need to add that to this 16,000. Okay, so now we're going to add all of this. So it'd be $24,303.96. That's how much was paid by you. So now we would take this $1,094,352 and subtract the $24,303.96. So you were left with $1,070,048.04. This would be how much of a profit you made, which is still quite handsome. Okay, now it says here, how much money would our investor have saved by using an online trading site with a flat commission of $19.95? Okay, so first of all, the flat commission is $19.95. So it's $19.95 to buy, and it's $19.95 also to sell. So we're talking a total here of $39.90. Okay, now we go here where we had the commission. One commission we know was $16,415.28. But then we go back to the previous page and our commission was $154.68. Now we add these two together. So we got $16,569.96. Now to find out how much we would have saved, we got to subtract that $39.90 from it. So you would have saved $16,530.06 if you would have did it with an online broker. So that is a big difference. All right. We move on over to this next page. And we're dealing with price over earnings ratio. The price to earnings ratio, commonly known as P/E ratio, is a key indicator of how reasonable the current price of a stock is. It compares the selling price of the stock to the annual amount of money the company has earned per share. If the price over earnings ratio for a certain stock is 20, that means that the current selling price is 20 times as high as the earnings per share. This tells us that for every dollar you invest in a company, that company will earn a nickel. Price over earnings ratio can be a little tricky to interpret. On the one hand, a lower price over earnings ratio indicates that a stock is priced reasonably, as you need to invest less for the company to make a certain amount of profit. But if investors believe in the growth potential of a company, they may be willing to pay a premium for the stock, which will result in a higher price over earnings ratio. To help get some perspective on price over earnings ratio, it's useful to do some calculation. First, a formal definition. All right, now, so price over earnings ratio is the current market price divided by annual earnings per share. All right, number one, for the Facebook stock table from earlier in the lesson, calculate the price over earnings ratio using the current price and earnings per share. Compare it to the price over earnings ratio listed in the table. Why do you think they're not identical? Okay, so let's take a look. Price over earnings ratio is equal to the current market price. We're going to use Facebook. Is $87.27 divided by the earnings, the annual earnings per share. Now with that Facebook example, see if I can find it. Oh, here we go. So the current price was $87.27, and then the earnings, the annual earnings per share. So let's see. EPS, earnings per share, is 0.98 cents. So it'd be 0.98. Now when you divide this out, it's 89.05. Now it asks us, how come this does not look the same as the table? Because the table tells us that the price over earnings ratio is $88.69. So basically, the table says $88.69. So it could be a rounding error. And needs to be updated. All right. Number two, Not every stock table you will encounter has quite the wealth of information that the ones at the beginning of this lesson have. A more abbreviated table might have the price over earnings ratio, but not earnings per share listed, in which case you could rearrange the above formula to calculate earnings per share. So number 2, it says on September 8, 2015, Google stock closed at $600.70, and the price over earnings ratio was listed as 28.31. What was Google earnings per share for the previous year? How does it compare to Facebook? Which do you think was the better investment at that point? So we know we have price over earnings ratio. And we know that is equal to the current market price divided by the annual EPS, annual earnings per share. Okay, so we're going to go through and substitute the values we have. We have the price over earnings ratio, which is given here. So that would be 28.31. Now, the current market price, they told us was $600.70. So we don't have the annual earnings per share. So that's what we're solving for. Now, what I would tell you is this here. We're basically doing algebra. We could put this over 1 and do some cross multiplication. It'll be 28.31 times annual earnings per share is equal to 1 times 600.70. So it'll be 600.70, and then we had 28.31 AEPS. Divide each side by 28.31. And then your annual earnings per share will equal to $21.22. Now, it asks us, which do you think was the better investment at that point? Okay, Google is much higher than, what was that, Facebook. So Google is probably the better buy. All right. Okay, now I'm going to move on to the next page. There's not really much more we need to do with this lesson. Hey, let's look at number 3. It says, come up with some ideas why the Facebook price over earning ratio might have been sky high in September of 2015. You might want to look up the history of Facebook stock on the internet. Okay, now, many people felt the stock was overpriced. Because it had just gone public. It had such a big name, people were overly excited about it. All right. Now they do give you some common interpretations about price over earnings ratio. So so it'd be good to maybe memorize these numbers for if you ever get into investing in the stock market, you have a good idea of what these numbers mean. All right. Now we move on over here to problem number 4. It says find the amount of interest that will be paid on the bond at maturity and the total amount of money you'll get from the issuer at that point. You'll want to reach back into the archives and use a simple interest formula. It says, suppose that you buy a bond with face value $1,000 that was originally issued 18 months ago. The maturity date is 4 years from the time it was issued, and the interest rate is 4% simple interest per year. If you pay $820 for the bond and keep it until the maturity date, what is your profit? What percent return would you get per year? Let's do some calculating. Okay, so first, we can do it interest is equal to principal times rate times time. The principal was $1,000. The rate, let's see, is 4%. And the time is 4 years. So that would give $160 in interest. Okay, so now the bond, it's $1,000 face value plus $160 in interest. So that would be $1,160 will be the total received. All right. So you paid $820 to get $1,160 back. That's not too bad. All right. Now we move on to the last page of this lesson of 3.5. It says find the profit you make on this transaction. So you got $1,160. You subtract the $820 you paid, and that will leave you $340 profit. Okay, number 6. What percent of your investment is the profit made? So basically, we had $820 is what was paid for it. The profit is $340. And when you divide that out, it'll give you 0.415, which is 41.5%. Okay, number 7. If you divide your total percent return from question 6 by the amount of time and years that you hold the bond, you'll get your percent return per year, or annual return, which is a key indicator of how well an investment performs. A long-standing rule of thumb on long-term investments is the stock market is that you can expect annual returns in the 6 to 7% range. How would this bond investment compare? So you have 4 years, but you subtract off 1.5 because you didn't buy it until 1.5 years went by. So it'd be 2.5 years. So we would take this 41.5% and divide it by how many years we had, which is 2.5. 2.5 years, actually. Okay, so we will put this in our calculator. So we have 41.5. We don't have to put the percent. 41.5 divided by 2.5. And I'll explain why we don't have to put the percent. So this would be equal to 16.6% per year. Now, the reason why we didn't have to do anything with this percent is whatever this divided out to be, we were going to add the percent at the end anyway. So we didn't have to divide the percent or change it to a decimal. All right. So that basically took care of 3.5. Now we need to go on to 3.6. Now just to let you all know, 3.6 actually starts on page 283. So let's go over here to page 283. Now I do need to tell you all this. This lesson is not long as far as pages and what we have to do, but it is a little long by how the problems are set up. So this is where Desmos will become a very, very good friend to you. Just like it was when you were doing those monthly payment problems. In this section with calculating taxes, Desmos will help you out. All right, so we go here. It says lesson 3.6, a taxing situation. Learning objective is to understand why we pay taxes, explain the basic process of paying taxes, determine the amount of tax due based on taxable income, and complete a 1040-EZ form. Now, we go over here. We're given this table. Now, I believe this table, I think it was from 2017, no, 2014. This table is from 2014, and our tax laws have changed. So this is kind of outdated, but we can use it for the class. All right, now, let's look here at number 1. If a person filing as single has taxable income of $42,000, what tax bracket is she in? So we go to single, and 42,000 will be between these two values. So it'll be single, it'll be 25%. Now it says, what about married person filing jointly? Married filing jointly. All right, so we'll go to married filing jointly, and we will go to where 42,000 would be, which would be here, and that would be 15%. It says, now for a big question, how much would that single person pay in taxes? If you said 25% of 42,000, that's a fine guess. An incorrect one, mind you, but a fine guess nonetheless. So what's the deal? What does the 25% tax bracket mean? In short, all taxpayers that are single pay 10% of the first $9,075. Then they pay 15% on the next $27,825, which is the amount that falls into the range 9,076 to 36,900. Finally, they pay 25% of the amount over $36,900. All right, I'm going to explain this a little better when we get to some practical problems. And just to let you know, we're only going to do I think we only got about 5 more problems, and then we're done with 3.6. Okay, number 2. It says using the information just provided, which is from that table, calculate the amount of tax that our single person would pay on income 42,000. All right, so I want to take this very, very slow. Remember, this person is single, and that plays a big part in it because that will let you know where to go to. So they're single with $42,000. So we go single 42,000, that'll be at the 25 percentage. So listen, what we have to do, instead of taking the 25% and multiplying it by 42,000, that would give us an answer. It would be a higher answer than what you would need to pay. But let me show you how this is set up. When we look here at single, at 10%, the max is $9,075, right? But we want to get everything up to 42,000. So what you would do, you would take this $9,075 and multiply it by the 10%. So that took care of that. Now the next thing, we have our 15% here. But if you notice, this only goes up to 36,900. So we're going to take the largest number here. Now listen, when I say take the largest number here, when your number does not fit, this is what you would do with the second portion. You're going to add. But what you're going to do is take this largest number here and subtract it from the larger number here. And then multiply it by the percent where it's at. Now let me explain why I did that. The first $9,075 is taxed at 10%. So when you go over here, you need to get rid of the $9,075 or you will get taxed twice on that $9,075. Okay, now, last but not least, we have our category, which is the 25%. And we notice that the 42,000 does fit in between here. So what you would do with that 42,000, you would take your 42,000 and subtract the larger amount from the previous tax table rate. So it'd be 32,000 minus 36,900, and that would be multiplied by 0.25. So basically, this is what we need to put in. So let me type this in real quick. So we have 9,075 times 0.10 plus 36,900 minus 9,075. Plus, oh, you know what? I didn't do the percent. So it'd be times 0.15. Then we would do plus parenthesis 42,000 minus 36,900. Close that parenthesis and then open up the other parenthesis for the 0.25. And now your tax here would be $6,356.25. Now they ask us another question. How much would she have overpaid had she simply paid 25% of her taxable income? So basically it's saying if she would have took 42,000 and multiplied it by 0.25, that would have given us $10,500 that she would have paid. So to find out how much more she paid, we'll subtract the $6,356.25. So this would be $4,143.75. That's how much would have been overpaid. Almost double what she should have paid. Okay, number 4. It says here, using the tax bracket info on the previous page, if Mr. Brown believes the tax table, will you pay too much or too little and by how much? Okay, now we have an example. Mr. Brown is, well, before that, let me read above here. It says, since many Americans are, shall we say, somewhat math challenged, the Internal Revenue Service, IRS, the government agency responsible for collecting taxes, publishes tables that let filers look up the amount of tax that they should pay. Their documentation even includes an example with the instructions. In this case, the case for Form 1040EZ, which we'll study in a bit. Okay, Mr. Brown is single. His taxable income on line 6 on Form 1040EZ is $26,250. Let's just write that down. He follows 2 easy steps to figure his tax. He finds the 26,250 to 26,300, which is here. He finds the single filing status column and reads down the column. The tax amount shown where the taxable income line and the filing status line meet is $3,488. He enters this amount on line 10 of Form 1040EZ. Okay, so they want us, so I'm going to write this down. This was his tax according to this form. So tax from form, which is this $3,488. So now they want us to do some calculations. So if we go back to this table, remember the first, and Mr. Brown is single, the first 9,075 is multiplied by 10%. Now if we look at this second tax bracket, the 26,250 fits in this second tax bracket. So we would take the 26,250 minus the 9,075, because remember we've already taxed that, and then multiply that by the 15%. Now we'll put this in our calculator. So we have 9,075 times the 10% plus the 26,250 minus the 9,075 times 0.15, and that will give us $3,483.75. Okay, this is how much you were supposed to pay. So basically, you would overpay. It's only going to be about what, $4.25. You would overpay about $4.25. Well, okay, so now we move on here to the back. Okay, it says here at the top, what would happen to you if you fail to pay your taxes? Discuss, and if you're able, maybe do a little bit of internet research. Here are a few things. You could be fined, you have a lien on your property, and garnish wages, credit rating will be affected. And then finally, number 4, you can go to jail. Now, we move on to this last page here. And on this last page, we only have two problems we need to answer. It says here, if you paid $6,500 in federal taxes in 2014, how much of your money went to education and job training? Now this goes back to this other page. It says, where do your tax dollars go? While paying taxes really stings, it can help at least some to know exactly what those dollars are accomplishing. The government maintains a website. The link is listed under the graphic below that illustrates where federal tax dollars go. And for people that stink at percents, which of course does not include you, it's possible to just enter a taxable income and see how that money gets divided up. But we don't need that. We could just use the percents. Okay, so said you paid $6,500 in federal taxes. How much of your money went to education and job training? Okay, so education and job training is 3.59%. So it'll be multiplied by 0.0359. When you put that in your calculator, $233.35 of your tax goes to education and job training. Now it says in 2014, the president paid $93,362 in federal taxes. How much of his money went to national defense? So he paid $93,362 in taxes. Then we go here to national defense is 23.91%. So we'll multiply by 0.2391. We put that in the calculator. It'll be $22,322.85. So that is basically it from section 3.6. So if you have any questions, you can email me. Have a nice day.